Imagine waking up one morning in Paris, Berlin, or Madrid and feeling a jolt of unease. You walk down the bustling boulevard, and something's different. The cafes are still full, the trams still arrive on time, but there's a quiet tension in the air. Workers speak in anxious tones about stagnating wages. Younger people move to London, Toronto, or Dubai for better career opportunities, and businesses increasingly look at markets outside Europe as more promising for growth. You might glance at the headlines and see modest GDP figures that don't look catastrophic. You might see inflation that has largely been tamed and unemployment rates that seem stable. But beneath those surface numbers lies a more troubling story, a creeping economic malaise that is collapsing Europe's economy faster than anyone expected, and few people fully understand why. Today on the Calm Capital Historian, we're going to peel back the layers of this story. We're going to go beyond the headlines and dissect the real forces weakening the European economy, how this is reshaping global power, and why Europe's woes are not just temporary bumps in the road. We'll examine demographic shifts, structural weaknesses, political paralysis, and global competitive pressures that together are pushing Europe toward economic stagnation. Stay with me, because if you think Europe's economy is simply slowing like always, you're missing the deeper dynamics that are quietly transforming the continent's economic destiny. Let's start at the beginning of this unfolding crisis. Europe's economy is not collapsing in the dramatic sense of banks failing or stock markets imploding overnight. It is collapsing in a slow structural sense, a weakening of growth potential, competitiveness, productivity, and long-term resilience that is far more dangerous precisely because it's harder to see until it's already too late. In the standard economic forecast for 2025 and beyond, the Eurozone is expected to grow modestly, but at rates that barely keep pace with population or inflation. Real GDP growth projections for the euro area hover around 1.2 to 1.4% annually, a fraction of what dynamic economies like the United States are expected to grow over the same period. This is below levels needed to significantly raise living standards or reduce public debt burdens sustainably. Even these headline numbers tell only part of the story. Growth is uneven, with some smaller economies growing meaningfully, while large economies such as Germany continue to stagnate and others struggle to maintain momentum. So why is this happening? What are the forces dragging down what once was considered the world's most prosperous and stable economic bloc? One of the most critical issues is the productivity problem. Over the past few decades, the European Union's productivity growth has consistently lagged behind major competitors like the United States and parts of East Asia. Productivity measures how much output is produced per hour of work. When this growth slows, wages stagnate, competitiveness weakens, and economic expansion falters. Europe's investment in research and development, venture capital, and emerging technologies has trailed dramatically compared with the US. While American firms invest heavily in intangible assets like software, AI, and digital platforms, Europe's approach has been more cautious and fragmented. This means European firms struggle to compete in the high-growth sectors that are reshaping the global economy. And this ties into a deeper structural problem: Europe's rigid economic framework and regulatory environment. While regulation can protect consumers and the environment, overly complex and fragmented rules across 27 member states create barriers to scaling businesses and new industry creation. This fragmentation increases costs, slows down innovation, and discourages investment compared with the unified markets of the United States or China. Meanwhile, the European economy is also experiencing demographic headwinds that few policymakers have truly confronted. Birth rates in many European countries are well below the replacement level, meaning the working-age population is shrinking while the elderly population grows. This demographic shift increases public spending demands on pensions, healthcare, and social services exactly at a time when the base of workers paying taxes is shrinking. This demographic drag is not theoretical. Europe's aging population is already exerting downward pressure on economic activity, labor force participation, and national productivity. As fewer workers are available to support more retirees, fiscal pressures mount and growth potential declines. Europe's labor markets look reasonably stable on the surface, with unemployment relatively low in many countries. But these figures disguise deeper weaknesses. Participation rates among prime-age workers have stopped rising meaningfully, and youth unemployment remains stubbornly high in several nations. Without a swelling base of productive, well-paid workers, consumption and investment struggle to pick up the slack. At the same time, public debt levels across Europe are high and rising, exacerbated by decades of generous social spending and commitments to public pensions and healthcare systems that were structured for a different demographic era. Much of Europe's welfare model is based on pay-as-you-go systems where the current workforce funds current retirees. With fewer workers per retiree, this model becomes increasingly costly and politically sensitive to reform. Fractured politics make necessary reforms deeply difficult. In countries like France, attempts to raise the retirement age sparked massive protests and political backlash, forcing governments to back down. Across Europe, aging voters tend to resist cuts to pension benefits, even as fiscal pressures rise. This political inertia compounds economic stagnation because it limits the ability of governments to adapt to structural realities. Another critical factor is Europe's industrial base and global competitiveness. For decades, Europe's manufacturing and export industries were world-class, driving economic growth and global influence. But industries have slowly lost ground to competitors due to higher energy costs, regulatory burdens, and slower adaptation to new technologies. Germany, once Europe's economic engine, has struggled significantly, with contractions in manufacturing output, sluggish demand, and structural challenges that predate recent shocks. These challenges were exacerbated by external shocks such as the global pandemic and Russia's invasion of Ukraine, which reshaped supply chains, energy markets, and trade patterns. Rising energy costs in particular hit energy-intensive industries across Europe, weakening competitiveness while the United States and others benefited from cheaper feedstock and energy supplies. Energy independence was a strategic priority for Europe, but the transition from Russian gas and efforts to accelerate renewables came with short-term disruptions and costs that weighed heavily on industry before new infrastructure and alternatives were fully in place. Europe's economy has shown resilience in certain areas, and parts of the bloc have rebounded, but the cycle of stagnation has lasted longer than most economists expected, with growth repeatedly weaker than forecasts. This sluggish recovery has been referred to in policy circles as a zero-growth trap, where traditional sources of economic momentum fail to materialize. Trade dynamics are also shifting in ways that put further pressure on Europe. China's export push in technologies and manufactured goods is rewriting industrial competition globally. Cheap imports once helped keep inflation low in Europe, but now the trade-off is eroding domestic industries' margins and competitiveness. At the same time, rising geopolitical tensions, protectionism, and global supply chain realignments are forcing Europe to navigate an increasingly complex global economic landscape. Global demand patterns are evolving fast, and Europe's ability to adapt is slowed by internal debates, regulatory differences, and slow decision-making across member states. So where does this leave Europe? Is the economy truly collapsing? It depends on how you define collapse. Europe is not tearing itself apart in an instant, but it is being reshaped by forces that are weakening its economic dynamism relative to other major powers. Growth prospects remain modest at best, public debt burdens are rising, demographic headwinds are intensifying, and political constraints hinder necessary reforms. This is not a dramatic moment of crisis, but rather a long downward arc of missed opportunities, structural inertia, and competing priorities that undermine long-term growth. Europe's future economic trajectory will be determined by whether it can enact deep and sometimes painful reforms to labor markets, productivity, innovation, and fiscal sustainability. Reforming pension systems, embracing technology and innovation, unifying regulatory frameworks, investing in education and digital infrastructure, and enhancing labor mobility across countries could revitalize the continent's competitiveness. But these reforms require political courage and societal consensus that has been difficult to achieve. In the coming years, Europe may be forced to choose between preserving the social models of the past and embracing the structural changes necessary to thrive in the 21st century global economy. This has been another deep dive from the Calm Capital Historian. If you found this analysis thought-provoking, share it with someone who wants to understand not just where Europe's economy stands today, but where it might be heading tomorrow. Stay curious, stay calm, and until next time.